All right, so welcome in everyone to the live stream. We're going to be covering Jerome Powell's speech today. This should give us some indication of where the market is trending according to the Fed. Welcome back into the show. Let's get started. I do want to thank our sponsor, and that's iTrust Capital. This is where you guys can go out there and get your own crypto IRA started. It's very easy to set up, whether you have an existing IRA that you want to move over, 401ks. All those are available to jump into itrustcapital.com. You can buy, sell crypto, of course, gold and silver over there as well, with silver moving. Might be a good place to kind of check this out. So use our link down below. It's going to give you a $100 funding reward to get started. All right, so Chair Powell is going to be going live here momentarily. We will most likely get an outlook around what the Fed is looking at in terms of data toward the end of the year. This is a very key date. If you look at one of the Fed governor's statements here just this morning, this is kind of interesting because I think when you look at the overall issue, and this is one that I've talked about a lot in terms of that, yes, July should have been the rate cut period. And this was, of course, them opening up. Michelle Bowman was talking about this here. In my view, committee should have been lowering policy rate in July, signs of potential labor market fragility. This is the first time I've heard fragility used in a statement, which usually tells me that they've got new data. And maybe some of the data that they're starting to see right now on jobs is continuing to push. Recent data have revealed materially more fragile labor market, which has been coming. I don't think we're going to see any changes on that as well. The policy decision and the path forward, we're at serious risk right now of already being behind the curve. Listen, you're already behind the curve on these deteriorating labor markets because it takes months, if not close to a year, to recorrect into traditional business for them to feel confident to go back into a hiring phase. So I'm concerned that we'll need to adjust policy faster at a pace much larger than we've been using going forward. So I don't know. This just seems very unorganized, at least from my viewpoint of where the Fed is. And the only thing I can think is that there's just ulterior motives here. And it boils down to very simple things. What data are you and have you been looking at? Because if you haven't been looking at real data, then what is the purpose of the data to look at the wrong data? And now we're continuing to see this information kind of flow out. If you look at Poly Market right now, this is how many Fed rate cuts. I'll zoom in on for you guys right there. Still on the 3, which means we have 1, 2 more, October, December. Likelihood is that'll roll into January and we'll get more rate cuts at the beginning of next year. But right now, 50 basis points still in play, but it's definitely declining a lot right now. And if you look at just this decision in October, you can see that one's pretty much, I won't say locked in, but it has been in a position that seems to be holding right now in terms of another 25 bips coming in October. Let's get into a clip. I want to play a clip for you guys. This is Dave Rubenstein, who's talking about Trump and whether or not he likes the moves by the Fed. Take a look.
The Fed did what most people thought it was going to do, which is to have a rate cut of 25 basis points. President Trump didn't applaud that. He didn't criticize it either. I presume he wanted a bigger rate cut, but generally he was okay with it based on what I've heard, such that he's not under pressure immediately to go do another 25 right away. But I suspect when the Fed meets again, another 25 basis cut would probably be on the table. I don't want to speak for him. But my guess is that he will follow the pattern of every other chairman of the Federal Reserve, which is when their chairmanship is over, they depart from the Federal Reserve. Yes, he could theoretically stay longer, but once you've been the chairman of an organization for a long time, it's very difficult to stay around as a regular board member. So no, I believe, but I don't want to be making news about it, but I believe, based on everything I know, that he will step down as chair and step down as a board member when his term as chair is over.
I totally agree. I don't think he's going to stick around at all. Jerome Powell out as Fed chair in 2025. Not a high percentage that would play into this coming in from Poly Market again. So not really any moves, I think, until after the first of the year and the final cut in December that we will see. I think the 2 quarters are, for most part, locked in. As you guys can see right there, they're starting to discuss about this speech that Chair Powell is going to give. I don't know that this is a surprise rate cut. What I think this will be is maybe a shift in the economic outlook. And if Powell is smart, this is probably a good thing for him to get in front of this, because it could, help solidify his position as a chair in terms of historical, position, but also maybe economic, because there are some things that could be playing into this that I think Powell could at least have some influence over. And part of this is how the data is disseminated. That's going to be a big question. And I think still we're looking at who is Trump going to announce as the chair for next year. Right now, it doesn't look like we're going to get any announcements before the end of this year. This is just talking about whether or not it would happen in 2025. The likelihood is this list right here is going to shift around. You got Chris Waller at the lead right there at 21%, Kevin Warsh, Hassett, and then even Michelle Bowman, who made the statement this morning about, man, we really effed this one up because we should have been cutting in July. And the job market is much more screwed than we thought. The other things that play into this is why, with all this bullish news, because we've got a lot happening in the markets. Paul Atkins come out with some very good news. We've got deals being made in the EU. The markets seem to be very bullish when you look at the S&P, gold, silver, all-time highs. Why is Bitcoin struggling as we continue to see a potential now with faster rate cuts? Because it seems like this requires a lot of good things for us to see real movement in the market. Let me know what you guys think are the issues right now. What's the number one thing that you think is holding back Bitcoin from starting to maybe cut a new high? Gold futures right now extend their gains to a record $3,800 an ounce. This is 42% up in 2025. Peter Schiff is gloating over there right now. Even amid one of the strongest bull markets in history, this puts gold up 3 times as much as the S&P 500. Man, gold bugs are on fire for this kind of movement. And let's not forget, this little move right here, I don't know if you guys have been watching our channel, and we'll go to the poll real quick. Is Powell going to surprise pump today? Wow, you guys think that might be doing it? I don't know. I'm still not looking at a surprise pump. A surprise pump, but not a surprise cut. One thing that we referenced here, and if you haven't been watching our channel, first thing I want you to do is just take some time, hit subscribe, because you get these kind of live streams, but you also get a lot of the alpha that we bring in, and it's usually caused by the research that our team does. And we did a video on this about 10 days ago. And the issue was silver and why it was starting to really move and break out. Silver, of course, has been on a tear the last few days. And the reason is we believe, and with the research and also our analyst that we brought in, which was Annie Scheckman, believe that silver's priming up for a lot. Now, we will be going to, hopefully, to Chair Powell's speech if he's not delayed. And we'll try to get that in to give you guys a full live view of that as they start to gear up to it. So they're going to be talking about some of the announcements from an economic condition. I think Chair Powell, when you look at what he has done in speeches like this in the past, in many cases has been trying to validate their decisions of how they did things previously. Some of the time, it is also setting up for how these governors and also how the market looks at these forward-looking statements going forward. So all of that is potentially going to be hitting today. Breaking right now is the money market funds are starting to hit another record at 7.7 trillion last week. And you wonder, where is all this fund? Look at that. Let me kind of zoom in on that. Look at that little zip right there. This little zip right there, I'm thinking might be coming off of some of these all-time highs, because we've seen this in the S&P. Are people starting to position into cash or trying to get ready for risk assets? Because where's that cash coming from? Is it coming off the sidelines, maybe from other investment components that they say, hey, listen, I'm going to go ahead and sell real estate, or I'm going to divest of other assets, businesses, equity, et cetera, that could play into that. But right now, by comparison, national average on the savings account yields right now 0.6 versus what we've been seeing in the current scenario when it comes to money market funds. Now, I will say this. We're probably going to see in the 3% range of money market funds very soon. And October coming up, another rate cut. I have already started to see even some of the crypto exchanges dropping their rates on USDC and some of the stable coins. Anticipate that for the money market funds as well. The one to keep an eye on over there would be Fidelity. If Fidelity starts to move that rate, you can bet the rest of the market is going to follow suit, and that's when I think we would start to see a lot of investors, not all, but a lot of investors start to look for what other assets can I go into. Maybe DeFi plays into this. Staking would be, I think, a clear winner, whether it's ETH, Solana, or many others. But that, I think, will be a strategy that we're going to see investors start to move into. Now, I want to go over to another clip real quick before we get into the live stream there. And this is Mike Wilson from Morgan Stanley, and he's talking about whether or not this is a rolling recovery. Listen to what he had to say.
You think the recession risk is behind us and we're reaccelerating now? The economy is reaccelerating already.
Whether you're looking at job cuts or you're looking at the payroll revisions, we have the right narrative now. The market, by the way, is our confirmation. The market figured this out at the exact same time. So that, like the old adage, trust but verify. We trust our analysis, but the market kind of verifies it.
I was going to ask you, if we went through a recession, why are we at new highs?
In order to get a full recovery, right, the rolling recovery now, we need rates lowered. One of the reasons why we've had a tepid, kind of economy in the private sector is because rates are too high for most businesses, particularly small businesses and consumers. So they do need to cut rates. The question is, how much are they going to cut? And that's why we haven't seen the full rotation yet to the early cycle, small cap, low quality parts of the market. Okay, so I believe that last week was sort of a sell the news event because the Fed is sort of dragging its feet. They cut 25, and the market really wants or expects, or it's priced for, more importantly, for something more aggressive.
All right, so price for something more aggressive was his last statement there. And this is interesting. We've had Darius Dale. I don't know if you guys follow Darius Dale, 42 Macro, been on our show many times. And Darius and I have had this conversation of, is this market, and what this analyst from Morgan Stanley was talking about, are we accelerating into it? Now, I will say this, that these markets will move over a long period of time. You have to think also, everybody watching our channel, you're probably into crypto for the most part. Maybe there are some of you that are brand new to crypto, which if you are, by the way, hit subscribe right now. But the point is that we understand that crypto markets move much faster. The traditional markets move much slower and we think are very lethargic. And that's what the analyst is talking about. This would be if, in fact, we are a rolling recovery here going into 2026. We could see some things that play into this. And a note I wanted to touch on, looks like they're still prepping. And we will bring Powell to you guys. So this is going to be live of Chair Powell if they can keep him on time. And we'll try to get to that for you. Typically what he has done in the past, like I said, if you're new to the live stream, basically what we're doing is broadcasting around Chair Powell's speech. The key here is how Chair Powell's speech is going to impact the markets. Many people are concerned that the cuts, just as a kind of a recap here, that the cuts have not been aggressive enough and that we need to possibly even either accelerate or possibly get an interim cut even going in. So there's discussions all over the place. Looks like Chair
These
Powell
babies need around-the-clock monitoring in busy neonatal ICUs. For new parents, it's an experience that can leave them feeling helpless and exhausted. They want to bring their babies home. But how can they get the miracle of modern healthcare in their own home, which research shows is...
It is a pleasure to be back in Rhode Island. The last time I had the opportunity to speak to the Greater Providence Chamber of Commerce, as Lori mentioned, was in the fall of 2019, actually November 25th, 2019, and I said then, quoting, "If the outlook changes materially, policy will change as well." Well, little did any of us know, just a couple of months later, the COVID-19 pandemic arrived. Both the economy and our policy evolved dramatically in ways that no one could have predicted. Along with actions by Congress, the administration, and the private sector, the Fed's aggressive response helped stave off historically severe downside risks to the economy. The COVID pandemic came on the heels of the painfully slow, decade-long recovery from the global financial crisis. And these two back-to-back world historical crises have left behind scars that will be with us for a long time. In democracies around the world, public trust in economic and political institutions has been challenged. Those of us who are in public service at this time need to focus tightly on carrying out our critical missions to the best of our ability in the midst of stormy seas and powerful crosswinds. Throughout this turbulent period, central banks like the Fed have had to develop innovative new policies that were designed to deliver on our statutory goals during times of crisis, rather than for everyday use. Despite these two unique, extremely large shocks, the U.S. economy has performed as well or better than other large advanced economies around the world. And as always, it's essential that we continue to look back and learn the right lessons from these difficult years, and that process has been ongoing now for more than a decade. So, turning to the present day, the U.S. economy is showing resilience in the midst of substantial changes in trade and immigration policies, as well as in fiscal, regulatory, and geopolitical arenas. These policies are still emerging, and their longer-term implications will take some time to be seen. Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. Job gains have slowed, and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak, but business investment in equipment and intangibles has picked up from last year's pace, largely reflecting the AI build-out. As noted in the September Beige Book, which I bet you wonder what it is, the September Beige Book, that's a report that gathers qualitative information from across the Federal Reserve System. We'll talk about later. Businesses continue to say that uncertainty is weighing on their outlook. Measures of consumer and business sentiment declined sharply in the spring. They have since moved up, but remain low relative to the start of the year. In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year. Payroll job gains slowed sharply over summer months as employers added an average of just 29,000 per month over the past 3 months. The recent pace of job creation appears to be running below what we call the break-even rate, that is the rate needed to hold the unemployment rate constant. But a number of other labor market indicators remain broadly stable. For example, the ratio of job openings to unemployment remains near 1, and multiple measures of job openings have been moving roughly sideways, not down, as have initial claims for unemployment insurance. Inflation, meanwhile, has eased significantly from its highs of 2022, but remains somewhat elevated relative to our 2% longer-run goal. The latest available data indicate that total PCE prices rose, that's personal consumption expenditure prices, that's the inflation measure that we follow most closely, rose 2.7% over the 12 months ending in August, up from 2.3% in August 2024. Excluding the volatile food and energy categories, core PCE prices rose 2.9% last month, also higher than a year ago. Goods prices, after falling last year, are driving the pickup inflation. Incoming data and surveys suggest that those price increases largely reflect higher tariffs rather than broader price pressures. Disinflation for services continues, including for housing services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs. Beyond the next year or so, however, most measures of longer-term inflation expectations remain consistent with our 2% inflation goal. The overall economic effects of the significant changes in trade, immigration, fiscal, and regulatory policy remain to be seen. A reasonable base case is that the tariff-related effects on inflation will be relatively short-lived, a one-time shift in the price level. Now, a one-time increase does not mean all at once. Tariff increases will likely take some time to work their way through supply chains. As a result, this one-time increase in the price level will likely be spread over several quarters and show up as somewhat higher inflation during that period. But uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We'll make sure that this one-time increase in prices does not become an ongoing inflation problem. Turning to monetary policy, near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate. The increased downside risks to employment have shifted the balance of risks to achieving our goals. We therefore judged it appropriate at our last meeting to take another step toward a more neutral policy stance, lowering the target range for the federal funds rate by 25 basis points to 4 to 4.25%. This policy stance, which I personally see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. We will continue to determine the appropriate stance based on the incoming data, the evolving outlook, and the balance of risks. We remain committed to supporting maximum employment and bringing inflation sustainably to our 2% goal. Our success in delivering on these goals matters to all Americans, and we understand that our actions affect communities, families, and businesses across the country. So thank you again for having me here, and I very much look forward to our discussion. Thanks.
All right, so we're going to get into some questions today. Keep them coming in. We'll try to answer some of those before they start on the interview side of this, because this is a get into a little bit more of the deep dives. This should get interesting because he's trying to frame up right now that inflation is not necessarily going to be a long-term impact, but yet labor they see as a freight train coming at them. So that is a problem right now for the Fed because it does create, well, it could be a one-sided problem because it won't create stagflation if inflation truly does start to levelize. So let's go back to the live.
Thank you for those opening remarks and reminding us just how tremendously the world has changed and evolved since you were last here in 2019. President of the Federal Reserve Bank of Boston, Susan Collins, is also here with us today. And President Collins, we have had the opportunity many times to discuss with you the conditions in this Fed region, of which Rhode Island is part of the Boston region. So, Mr. Chairman, I would ask you to think about your comments reflecting on the importance, what you have said, the importance of deeply understanding local labor markets. And I'm wondering if in your deliberations leading up to the most recent FOMC meeting, whether there was anything particularly distinctive in what you saw coming out of the Boston Beige Book.
So let me say a word about the Beige Book. So there are 12 reserve banks, as you know, around the country, and each of them has deep ties into not just the business community, but medical community, educational community, nonprofits. And each FOMC cycle, which is sort of 8 of those a year, they do a deep dive and they collect lots and lots of information about the economy. And so, and that information gets collated and put into what we call the Beige Book because it's beige. And we're not that original. And so we get that a couple weeks before each FOMC meeting. And I have to say, I don't know of any source of sort of qualitative information about the economy that even approaches this. It's just a lot of conversations with a lot of people, and I personally find it very useful. Sometimes you look at that book and you see significant regional differences, and this is not one of those times. So, for example, the Boston Fed piece in the last Beige Book talked about lots of spending on AI. Well, guess what? That was pretty common across 8 or 9 of the districts. So I would say nothing really jumped out from the Boston piece. What you saw was all around the country, you saw pretty modest growth, wage and price inflation at modest to moderate levels, the economy growing but not fast, and uncertainty, significant uncertainty about federal public policy is kind of weighing on investments and decisions about investment and hiring, except in the area of the AI build-out, which is just going really strong pretty much many parts of the country.
So nothing distinctive from the Boston region that would inform your future decision-making, looking at the setting of monetary policy?
What I saw from Boston was quite similar and overlapping with a number of other districts. Again, sometimes that's the case where things are pretty much of a piece. Sometimes different regions, particularly if there's a commodity price thing, you would see maybe things in the commodity-oriented regions doing differently from other regions of the country. Right now, it's sort of, it's much more the same around the country, I would say.
So let's talk about and build on what you described a few moments ago about the dual mandate of the Fed. And if you could talk about these conditions that wax and wane over time, what signals will you be looking for in the run-up to the next FOMC meeting, which is in roughly 30 days?
We have two goals, as you mentioned, maximum employment and price stability, and they're equal goals under the law. So almost all the time, they work together. They complement one another. So for example, when the economy is weak, the unemployment rate might be high and the inflation rate would be low, and that it calls for stimulus from us. And when the economy is really strong and the labor market is tight, that's when inflation will be moving up, and so policy might be a little bit tighter. That's almost always the case. Right now is the quite unusual case where risks to, as I mentioned in my remarks, risks to employment are to the downside and to inflation to the upside. Now, we only have one tool, which is monetary policy, really interest rates, and really it's calling for different answers. So for a long time, we have a document called the Statement on Longer Run Goals and Monetary Policy Strategy. We call it the consensus statement to save time. That says, for a long time, it's said that when the two goals are in tension, we'll look at how far each one is from its goal and the time that it's expected to take to get back to that goal. And so we balance the two goals. So what we've done all year this year is we've had our policy rate has been tight because inflation has been above our target, but the labor market was very solid. Now, over the last really 4 months, really over the summer, the labor market has softened. Payroll jobs have dropped a lot, so we can't really say that anymore. And I think what that told us is that stance of really having a tight focus on inflation really needs to moderate toward a more balanced approach. And so that's why we took the action we took at our last meeting. And as we go to our next meeting, to your question, we'll be asking ourselves, we'll be looking at the data very carefully, labor market data, growth data, inflation data, all of the vast quantities of data that we get, and asking ourselves, is there a policy in the right place? And if not, we move it there.
Some may wonder about the frothiness of the markets, the markets reaching record heights and also record valuations. How does the Fed think about that in the equation?
Financial markets? So we monitor financial markets very carefully. Our policy works through financial conditions. So that's credit spreads and interest rate levels and equity prices in the aggregate that can affect spending, for example. We look at all of that, but really our focus is on our two goals, and that is maximum employment and price stability. And when we see one of them weakening, we're going to respond appropriately with our tools. And in this case, that meant reducing the federal funds rate by 25 basis points. And, we'll see what the future brings, but that's what we do. We look carefully at financial conditions, more from a perspective, though, of financial stability. So we see that the banks are well capitalized. Actually, in the aggregate, households are in good shape financially. I know people at the bottom end of the income spectrum are under pressure. No question about that, but it's not a time of elevated financial stability risks.
Mm-hmm. So the federal funds rate really governs consumer credit, but not so as it pertains to mortgage rates, correct?
That's right.
And let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates, and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case, 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going, and so they'll price things in, and so longer term rates will move because of what the market expects, market participants expect us to do. So you'll begin to see, and you're already seeing, changes in rates long before we make the decision. It can often be already, priced in.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions. And we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
Let's segue to the topic of AI, and largely AI stocks and periphery stocks really driving the markets in many ways. Let's talk a little bit about the great unknown of AI, and if we think about various ages, our industrial ages, whether it be steam to electricity to the information age and now to the age of AI, would you consider this to be the most disruptive force ever in modern American history?
I think it's way too early to say that. I wouldn't go that far. I would say clearly generative AI has all the earmarks of an emerging technology that could be very important in our economy and in our society. But it's very early to be making that kind of bold statement. So, what we're seeing is companies and institutions like the Fed for that matter, are starting to experiment with how this new set of tools can be used in our operations. Mm-hmm. And it's very early days on that. And I think we have to wait and see. That's a good thing. I know many of the large financial institutions and other central banks, and we are asking ourselves, how can this help us do our jobs better? And I think it's going to be a period of experimentation over a period of years. And the history is always that there's a lot of fear that technological innovation will eliminate jobs. What has tended to happen in history over time is that it just raises productivity and creates new jobs to replace the old jobs. And that happens. And sometimes it can take a long time, but ultimately that has been the pattern for the last couple of 100 years. Is this time going to be different? I just don't think we know yet. I don't think anybody knows.
Mm-hmm. You are a labor market futurist, also a historian. And the concept of AI and humans in the loop, very profound impact on the labor force. What are your thoughts about specifically agentic AI as a differentiator from generative AI? And how will the Fed be looking at the impacts of the workforce, the labor participation rate, given the unknown of what could happen with displacement around AI tools at all ends of the spectrum?
Our tools work on demand, basically. Lower interest rates, higher interest rates, they work on demand. When there are structural changes in the economy, there's not a lot that an interest rate change can do for that. And so if you're talking about distributional issues or labor force participation or retraining or any of the things that come to mind in connection with those questions, that's really going to be something for legislators and the private sector. We of course, we have many labor economists, and a good portion of them are studying what the potential effects of AI on the labor force, and many, many great economists around the country and around the world are publishing on that now. And you know, it really is too early to say. I think you can say that some jobs are going to be phased out, some jobs are going to evolve, and people are going to be further trained and that sort of thing, and be able to keep a job like that. And there'll be new jobs that come. And how will that balance work out, and what will be the timing of it? I think it's just quite hard to say.
But how does that factor into the deliberations on a near-term basis? Things are moving so quickly, and the observation and the argument that artificial intelligence isn't just impacting those entry-level jobs and those, quasi-unskilled jobs, but really tentacles reaching into highly skilled professions, whether it be finance, whether it be communications and media, whether it be healthcare, whether it be law, finance. So all ends of the spectrum, highly educated individuals down to more easily automated tasks. Sort of a really interesting problem for those of you that are studying labor market economics. How do you approach that?
Well, a lot of what we're doing with our time is trying to understand the current position of the economy, what's actually going on in the economy today. Pardon me. So part of that is hiring rate has really dropped. Job creation has dropped very sharply. So what are the factors there? So I mentioned earlier, I think, part of it just is there's a lot of uncertainty about the direction of public policy, and so companies are holding off, they're not hiring, and when you don't hire through attrition, your labor force shrinks and you save money that way. That may be a way of passing on tariff costs. It may be something like that. So that's happening. Lots of questions around whether AI is a major factor associated with the relatively low hiring rate for people just graduating from school and just entering the labor market. And people are doing studies on that, and I looked at one from Stanford, another from the New York Fed in the last week, and the sense of it was, we think we can find some evidence that generative AI is having it's one of the reasons here, but we can't really say it's the main reason. And we have our Jackson Hole conference every year in Jackson Hole, Wyoming, and we had some great labor economists, and one of the big debates was what's going on with AI, and there was a professor from, I want to say, Columbia, who just basically said there's no evidence that this is acting any differently than her view was not acting any differently from other technological movements, waves. And so I think she would be more at the end of an optimist, a techno-optimist. Mm-hmm. We've all, there are books out there that will tell you the world is ending, and but I don't think we know. Again, I think we're going to see how this evolves, and again, if it does turn out to be something where labor force participation really declines in a way that creates social difficulties, that's going to be something that legislators and the private sector will have to address. We just don't know that yet, though.
Over the weekend, I read where you had been discussing, just picking up on what you said about Gen Z and college graduates and any possible disruptions in trying to find jobs. So Gen Z would be those born between 1997 and 2012, roughly ages 13 to 28. What are your thoughts on college enrollment? We'll talk a little bit about labor disruption in just a minute, and Jackson Hole, because I know that's a favorite of yours. But a lot of the individuals in this room today may have family members that fall squarely in that 13 to 28 category. What would you say about that?
I mean, again, we all see the data that it's just gotten tough for people just entering the labor force to be hired. But remember, the overall national aggregate hiring rate is at very, very low level. The layoff rate is also at a very, very low level. You're in a low fire, low hire economy, and it feels like companies are just They've kind of stopped hiring or slowed down their hiring because they want to see how this all shakes out. We're having very important changes to economic policy in the United States, and companies and people are wondering how's that going to work out. So I think that's part of it. The other thing I would add, though, is there's a lot of good scholarship around technological innovation and inequality, if you will. And the sense of it is really that if schools and society give students graduating the skills and aptitudes they need to benefit from evolving technology, you can have declining inequality over time. And that's what the United States had for many, many years, up until about 1970, when U.S. educational attainment kind of plateaued and inequality takes off. So it's really down to having the skills. So kids who come out of school today with technological skills and can work with this new technology, they're probably going to be fine. They're going to be great. If you don't have those skills, though, you're increasingly left with less attractive employment options. So in a way, it's an educational issue.
Our society is our education system, and you spoke about inequality, particularly the digital divide, and thinking about where the United States really has paced among countries throughout the world. Particularly, that was a subject that you initiated at Jackson Hole back in August. What are your thoughts on how that is likely to really change the way we look at technology as a force for productivity and advancement?
I mean, technology has been raising incomes and productivity for really a couple hundred years since the Industrial Revolution. It's been an amazing thing for the quality of human life, and there's no reason why that has to change. In the United States was the first country to have gender-blind secondary education, and if you go back, you'll see that there's a great book on this, but it just basically the U.S. had fast technological innovation for a century, and also declining inequality because people were coming out and their educational the capabilities they took out of the educational system gave them the ability to benefit from evolving technology. So, and that's really the key, because technology, what it does is it makes us more productive. One summer I worked on a project that was building houses, and I basically had a shovel and I just dug most of the summer. And now that would be a Bobcat, which can do 100 times the work, no blisters, no water breaks. It's just much more productive. And you see housing production's gotten, at least it did get for a while, much more productive, not so much lately. But that I think is the story. And while U.S. educational attainment, college graduation rates and things like that leveled out, they're still going up. The rest of the world caught on and has really caught up in terms of educational attainment. And that really is the key. To your point, your educational system, your country is your educational system ultimately. It's the people that come out and what can they do, and a variety of other factors too, obviously. But I think that's a key element. I'm struck by this because this was a major factor at our recent conference, and we had a great conversation about it.
Well, tell us about the book. You gave me a homework assignment the other day, so I did download it, but I think everyone should follow that lead.
All right. It's a book's called The Race Between Education and Technology. It's by Claudia Golden and Larry Katz, two Harvard economists, and it basically talks about the race between education and technology. So I'd recommend that to anybody. It was written in, I want to say, 2005, and they basically presented at Jackson Hole, they presented an update to the current day. The findings basically hold. It's very, I'm not a PhD economist. I read it 20 years ago.
But you said it still holds very much true today.
It does. And I think it's a good explanation for why the U.S. has had, rising inequality. This is their thesis, and I think it's they call it also skill-biased technical change. So you need skills to benefit, but if you have those skills, then technology makes you more productive, and that's what we need. Incomes can only rise if productivity is increasing. We're sort of working as many hours as we can work now, so it really is down to how much output can you have in an hour, and that's productivity. So I would recommend that. I'm not getting any royalties for that. But by the way, Claudia Golden won the Nobel Prize for her work about 2 years ago. So I'm not the only one who thinks it was good work.
Chair Powell, let's move on to tariffs. This is an issue that confronts the business people here with us today. You addressed it very briefly in your opening remarks. You indicated that you believe that the costs of the tariff movement is in fact more transitory than embedded in supply chain. So I think we would appreciate hearing more about how the Fed thinks about evolving tariff policy.
So we're now collecting a good bit of revenue. The government federal government collecting a good chunk of revenue, at a $300 or $400 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, or someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example, I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. So we've been watching this since the beginning. Half our mandate is inflation. And I would say that the pass-through to consumers has been later and less than we expected. How much of that will continue, I don't know. But the responsible thing from our standpoint was to watch and wait, because it's our job to make sure we don't make a mistake on inflation.
Well, that was my question. Do you imagine that is going to change, where the cost of tariffs will be more deeply embedded and passed on to the consumer? What do you foresee as?
So our forecast, and I think almost all the forecasts are for there to be a one-time pass-through, which will go through the end of this year, well into next year, and that by the end of next year, the one-time increase from the tariffs will be done, and you'll be back to the non-tariff related inflation, which should be much closer to our 2% goal. That's almost everyone's base case. It's actually our job to make sure that that's the outcome, though. So we can't be in a situation where we're just going to assume that. We can't leave that part of the goal unguarded. And so that's why we've been careful about cutting. We didn't want to cut too early. I mentioned in my remarks, if we cut too early, we may find out in a year that inflation actually wasn't under control and it's back up to 3.5% or 4%. No one thinks this is the base case, but that's the risk of cutting too early or too much. Of course, the risk of cutting too late, as I mentioned, is that we unnecessarily, the labor market weakens unnecessarily. There's no risk-free path, and it's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise, and we really, again, haven't been in that situation for many, many years. It does happen, but it's happened now, and we'll manage our way through it. But we sort of have to look at both of them as equal. We can't just say we're going to do this one and not that one, unless this one is clearly a greater risk. And now they're coming into closer balance, I would say. We do see meaningful weakness in the labor market now, very low job creation. The unemployment rate's still low, though, and the quits rate is low, and a lot of things suggest that the labor market has reached a kind of unusual stability of much lower demand and much lower supply for workers. It's a really unusual kind of a balance, if you want to call it that, but nonetheless, we think it's downside risk.
Well, if you could elaborate, what are some of the factors that are leading to depressed demand for labor?
So depressed demand for labor, based on surveys and talking to people who are doing hiring, a big chunk of it is that they're just unsure about what to do. Businesses, and I'd love to talk to people after this. businesses don't want to do a lot of hiring. They may be postponing major CapEx, major initiatives, major acquisitions, and maybe they'll replace workers who retire, but they're not looking to grow. This isn't every company and every part of every company in the world. It's just an effect kind of at the margin. That's got to be part of it. I think that's the demand side. The supply side, of course, has a lot to do with immigration policy. So immigration was at a very high level for 2 or 3 years before this year, and now immigration has really gone close to zero, and immigration is not really contributing to the labor force growth now, whereas it's been most of what the labor force growth was, and now so at the same time you've got declining demand and also declining supply of workers, of new workers.
One of your passions is demystifying the Fed. You enjoy speaking about it, and those that are Fed watchers are wondering, will there in fact be 2 additional rate cuts before the end of the year? Of course, we're uncertain about that, if I understood your comments correctly. What does it mean to demystify the Fed, and what can each of us in this room do to be better Fed watchers for the benefit of our own businesses, if you will?
So not so many years ago, maybe 40 years ago, and for a long time before that, the main theory of central banking was to be mysterious and obscure. In fact, Montague Norman, who's a very famous former head of the Bank of England, but ending in the middle of World War II, famously said, never apologize, never explain. And he thought that monetary policy worked back, and everyone thought it works best when no one understands. It's kind of mysterious. So starting maybe 40 years ago, a bunch of economists, including Alan Blinder and a number of others, said, you know what, that's wrong, because if markets and the public understand the way you'll react to incoming data, then they'll kind of do your job for you. And so they argued for greater transparency. And people said, you know what, that makes sense. So central banks started being transparent. The Fed didn't even issue a post-Federal Open Market Committee announcement until 1994, and then did so as an experiment just to see what would happen. Now, so if you fast forward through, the 30 years since then, now we have a post-meeting statement, we have minutes, we have press conferences, every FOMC participant is on Squawk Box, we have a press release. So, and maybe some people say it's too much, it's excessive, but so that's the way it's evolved. So we try really hard to communicate with the interested public in a way that is useful and comprehensible and jargon-free. That's what we focus on, and that's all we're trying to do. So we don't use their, every profession has their jargon, and you kind of need it for internal conversations, but we try not to do that. So that's all we're trying to do. A couple of thoughts about what I wouldn't say I can't make anyone a better Fed watcher, I don't think, but things I would want to tell people about the Fed. One is just this, that we're making decisions. Our decisions are made under elevated levels of uncertainty, even in normal times. The economy is fundamentally. No one has been able to predict the economy more than for the next few months. It's an unpredictable. It's this enormous entity, and it's just not that predictable. So we have to manage we take very much a risk management approach, and one of the risks we're managing is that we don't exactly understand what the current state of the economy is and where it's going to go. So we try to have policy that can cover the range of plausible outcomes, not just one outcome. So that's one thing. So we're never saying that we know the economy is going to do this or we know it's going to do that, because honestly, famous statement is financial forecasters are a humble lot with much to be humble about. So that's one thing I would say. Another is that you should, I just have to say this, whenever we make decisions, we're never ever thinking about political things. And so we're based in Washington, D.C., and many of people, in Congress, and they're often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, Mostly people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do. So those are two things I would offer about the Fed.
We have run out of time. We have come to the end of our program, and I'm wondering if there's anything additional that you'd like to share with the members here today, and again to help us be more prepared as we begin to look to 2026 and strategic plans for business and things on the horizon that would help to, of course, create more jobs and more prosperity.
So I'll say one more thing that struck me just now about the Fed, and that is, remember, we have a really important job: maximum employment, price stability. We regulate and supervise the banks. We operate parts of the payment system, but those things are really about cyclical demand management and financial stability. The policies that really matter for the U.S. economy in the long run, things like investment, particularly investment in people, that's not something we can do. I think we get a disproportionate amount of attention compared to the things that really matter for the country, which are the things that Congress can do and the private sector can do, which are the things that will really matter for future generations, are not interest rate policy and the things that we do as important as we are. And beyond that, I'll just say this has been great, as always. I've enjoyed talking to so many people here today, and I'd love to get out and talk to people who are working in the real world and the economy.
All right, so there you have it, guys. Not a lot of new updates. They are going to continue to take a look at data, even though with Bowman really putting the pressure on in terms of one of the Fed governors, there is a lot of pressure, I think, that are going to be coming from the rank and file in terms of the governors on being able to cut. Now, the question is really to get a quarter basis point into October. That Fed meeting, the FOMC, is the 28th and 29th of October. And then we end up in the first couple of weeks of December for the final Fed meeting of the year, which I think will be another rate cut. The question is really, how does the market respond to this? I think a lot of things are still bearing toward two things that are happening right now in finance. And one, of course, is going to be how the market structure bill goes through, even though there has been some delay on that. I'm going to talk about that in a second. Before I go to that, I want to go to some more bullish news here. Morgan Stanley is offering crypto trading. This is a bit of a surprise move. And I think as we see Morgan Stanley do this, you're going to see a slew of banks starting to opt in very quickly. It's interesting, too, because timing is going to be everything here. Do they already assume or know that the market structure bill is going to come through and become law? And if that is the case, then you're going to see some more surges moving forward. Here's another point right here. Bank of America survey says 75% of investors now have zero exposure to crypto. What does that mean for a bank? Well, that means they have all the cards, because this could be the cycle where if banks come in, remember the expectations from people who are not in crypto are not very high. You guys watching this show, or maybe you're brand new, your expectations are much higher. You've maybe gone through one or two crypto cycles, or maybe three. Point being is that you've seen these massive run-ups and these parabolic moves. Many retail investors have not. They've traditionally been in S&P 500. That's about as volatile as it gets. Maybe they're in gold right now. So the point being is that if the banks see 75% of investors have zero exposure to crypto, that means the banks have 75% of their customers that could be their customers for crypto. So that's the one thing to consider. BlackRock also, crypto ETFs will reach $260 million in annual revenue. And I think this is another key thing. As you see Wall Street starting to publish their revenues, this only expands the Wall Street echo chamber, because they're going to see what the Smiths are doing, the Joneses are doing, in this particular case, the BlackRocks are doing, and they're going to jump into the market. And with that, you're going to see all sorts of different strategies. One strategy that will play into this are digital asset treasuries. Digital asset treasuries now, latest views from Mark Newton. He hits on a couple of, Mark Newton, in case you don't know, is one of the analysts behind BitMiner, Tom Lee. Tom Lee is, I think, the spokesperson for Ethereum. But the point being is that we could get down to around 4,200. This is where we are right now. If you look at the chart on Ethereum, let me jump over to the ETH chart. Let me go to, actually, let's go to the, we'll just go to the, actually, let's go to the 1 hour. There we go. That's the 1 hour on ETH right now. This morning, after a drop down to around 41. So maybe Mark is right on this in terms of where this pullback could go to. So we could get down to, he said, we could get down to, so we're already through that by end of week. So that is done. Did you buy the dip? Are you buying ETH right now? His theory is that we're still en route to 5,500 by mid-October. This would be prior to the FOMC meeting, which is late October. So be on the lookout if we get to 5,500. I'm just kind of curious, when you look at the short-term outlook for Ethereum on to the end of the year, do you guys still feel that the 10K is in play, or is it the 7K? Evan and I talked about 7K in a year, possibly moving forward off of that. We are going to get to some questions. Before I finish up, I just want to answer a few questions here. Let me view the queue and see what the guys have. All right, let's go to a few. Don't buy ETH, it'll go to 2K. Phantom's coming in on that. I disagree with that, Phantom. I'm still an ETH believer. I think it's moving a little bit slower, but I'm still an ETH believer. Again, not investment advice, but me, that's what I'm doing. Inflation is hidden behind tariffs. Yes. Interesting that Powell, though, has lightened up a little bit on inflation, saying that he thinks it's only going to be a certain position and it will alleviate into next year, going back to near, did you hear his term? Near 2% target. So has he relegated to the point that 2% is unattainable in the future? That would be a big deal if the Fed repositioned their target going forward on inflation. Did he mention or imply cuts coming? He has mentioned, and his statement was the same as it was in the meeting last week. If you didn't catch our live stream, make sure and subscribe to the channel and hit that little bell. It's going to give you a notification when we do the live stream, because that live stream was a good one in the sense of at least understanding that they had finally succumbed to the realization that jobs were a problem and that inflation may not be as bad as they thought. So I still disagree with both. I think jobs are a much bigger problem. Fragile, I think, was the statement. Let me go back to the statement from the Fed right there. Yeah, right here. Fragile. That was the statement. If you guys missed this on the first part of we covered this. Signs of potential labor market fragility. Recent data revealing materially more fragile market in terms of inflation. So this goes back to my point. Jobs are going to be a problem going into the end of the year. This will put some more pressure on consumers, and I think it puts more pressure in general on retailers, which will be another big issue. I think we have one more clip that I wanted to go to, the Mark Newton clip. I want to go back to that one on Ethereum before we flip up here, because we got some other stuff I want to get to. Can we go to that clip, Sa3?
What kind of consolidation are you anticipating and for how long?
Honestly, I only think it lasts maybe 3 to 5 days at the max right now, and I think we probably push up into October. There is a really interesting phenomenon right now. We have this huge bifurcation because technology has done so well in the last month. The broader market has actually gone sideways since July. You look at the eco-rated S&P, we've made literally zero movement in the last 2 months, where it's all been technology. So
small caps up 7 weeks in a row. Yep. They did not perform last week, but they put in a good account of themselves. This is under a little pressure. People are a little concerned about that today. But this is par for the course with the volatility for this kind of.
That's right. One does not need to be concerned about Ethereum. It should go no lower than 4,000. I expect to move to 5,500. I like Ethereum a lot. It's my favorite of the crypto.
Okay, well, it should be your favorite. You know, everybody's got kind of a dog in the hunt there. All right, so we're going to go through a bunch of comments here and questions. Wick down to 3,600, then 7K. I like that angle there, Make Emil. Keith says XRP to 250. Barreling down. I don't think that is going to happen. What are your thoughts on NVIDIA and Intel? I like the strategy because it beefs up the American infrastructure on chip manufacturing. Tom Lee seems to believe we will hit 15K. If that happens, guys, it's going to be a party in the house here. I know that. Accumulating AVAX right now, that is a move right now. I'll reveal to you guys on the show. That is a move I'm making right now, is acquiring more AVAX. Self-custody is a competition for banks, but here's the problem with self-custody, guys. Even though if you're not in our Tangent cards, you should be. That's the issue, is self-custody in most cases is hard for people who have never done it, which is why Tangent has a good card for that, because it's super easy. You don't have to worry about keys, all those kind of things. That'll be the key, I think, on self-custody versus banks. And I believe that we're going to see more flow coming into TradFi than we have seen in all of the history of crypto. That's how big the market is, untouched. And the key here is if we get, now listen, remember, you got ETFs flooding in, all those companies on Wall Street barreling down on ETFs. This is a big deal. Paul, thoughts on Solana's target? Let's go over real quick on Solana. We had Evan on last week. We're looking at a 400 end of year. It was kind of our moonshot. Tesla or Solana, Ethereum 8,000 will come before 4,000. I like that. And then hyperinflation. Okay, I don't know if I necessarily agree with hyperinflation. I think that a recasting of inflation is going to be real. But yeah, and then silver we've talked about for sure. Why October? Again, this goes back to these cycles, and these are liquidity cycles. If you go follow and do some research on liquidity cycles, this is something that many people are talking about. This is a point, though, that Darius Dale made earlier, and I was going to mention this before we went into the live with Powell. And his point is that he thinks that 26 is actually going to be an up year. And his theory is that we could see a retracement and then a market blow off. So I don't know if that is the case. I'm going to get Darius back on the show to go through that detail of that process that 42 Macro is breaking down. But yeah, do you like any of the XRPL meme coins? You know, the meme coins on XRPL are, I think, going to do more. I think the bigger news now is XRPL for loans, staking, all that, if you're outside the U.S., because the announcement with Axelar and Matrix was a big deal. That was announced over at XRP Soul just this week. We dropped a video on it, I think, on Monday morning. You guys go watch that video because it's a big news piece for them. Aave and the new Bank of International Settlements protocols producing revenue. Yes, we're going to see more of that, and it will take time, but I do believe eventually DeFi wins because it will take time for the masses, and it's only going to be a certain percentage. But remember, 5, 6, 7, 10% of the masses is massive in terms of inbound for DeFi, and that will be the real question. Once people get a taste of what crypto can do in a traditional finance account with Wells Fargo, Bank of America, PNC, all these guys that are out there, imagine what they're going to go look for next. It's kind of like when you're credit card hunting. You're looking for the next big reward, which is another prediction. I think we're going to see credit card rewards. We saw the news on Stripe, and that is a big deal because that's now partnering with a Bitcoin credit card, trying to fight off the issue of Gemini, Robinhood, and Coinbase all going after. I think, man, the credit card business is going to get heated out there. Thoughts on HBAR? Still hold it. I'm holding HBAR. I like it. Welcome in, Mr. Solis, to your first live show. Great to have you. Hell of a bearish to me. I don't think so. I think we're still on the moderate to somewhat bullish side. First week of October. Many people like October. There's a lot of analysts pointing at that. I think November, so up November as we are looking at. DOT price target. We haven't been on and off DOT, even though there's a lot of good things happening with Polkadot. I've been in and out of that, and I just haven't been able to win on that one. AVAX, one of my biggest positions, still buying at 35 over other coins. Am I doing that, Paul? So I'm buying right now over at 30. I like that position, and I do like BitTensor Tau. It's the one we have actually on our portfolio with Evan. And I think I'll show you that portfolio real quickly. Hang on one second, guys. Let me pull it up if I can get it for you. Because this one was one that we, finally, we're back in a little bit of profit here. These were our positions that we had kind of gone into. Avalanche, we repositioned. If you guys didn't catch that video with Evan and I, we basically went out and did a 100K portfolio. These were our positions. Avalanche on profit-wise is our best right now. Holdings-wise, we're still number one on Ethereum. Avalanche is number 2, Chainlink number 3, Arbitrum doing fairly well, Solana, Aave, Jupe, and there is Tau. So there's BitTensor right there, the AI play going in it. Flare F assets going live immediately. We aired the Hugo interview with Flare, absolutely dropped bombs on that interview. If you didn't catch that video, Go back and look at that. Just search Flare on our channel, and you guys will get enlightened quickly. Flare is doing some crazy stuff. Robinhood just took me off the wait list, so I also saw Coinbase is sending out stuff to people on Coinbase One. Yes, Coinbase One has done it, and the Coinbase One credit card is pretty cool. I actually got one, and I was surprised at one. The packaging is fantastic. They really did a premium job there, but the ability to get real-time rewards in the app is pretty slick. I will say this, on the Coinbase One app, the pending rewards takes a while versus on Gemini, you get it almost immediately. So just be aware of that. The pending rewards is taking a while. I'm going to talk to the Coinbase team and ask them, why is that? Because Gemini is delivering these rewards immediately, which means you can benefit from the market if the market is booming and you're taking Bitcoin as the asset on the reward. Can ETH touch 3,900? I don't know. Maybe it could. If it did, I'd be a buyer. XRP is dead. William, make sure and take a screenshot of William right there. That screenshot right there. Let's get a screenshot of that one. William Keohane. I like that because I always love those kinds of comments. Alex, why isn't staking ETH currently and why wait? BMNR should be, but remember, the problem is being able to stake ETH legally, and I think that's going to be something we'll see more of, obviously playing into the markets. Good deal there. Do you like Chainlink? I'm moderate on Chainlink, but at the same time, I look at Chainlink and say there's a lot of upside to it. I tell you, if Tim was here, that's like his number one. So Evans price targets, alts, very, big fan of the show. Thank you very much. Evans price targets, also they're going through too fast, guys. Why do you get the feeling the Fed wants high rates? Because that's good for bankers. Why do I get no, I don't think so. I don't think they want high rates. I mean, I think they're trying to figure out how to navigate a job market right now, which is the biggest problem that they have. So anyway, we're going to do more of these live streams for you guys. Last thing that hit this morning was the securitized news right here. Ripple, RLUSD, BlackRock, Van Eck funds, all now within the securitized platform. We're going to try to get them on the show. We'll break down what this might mean. It may be a big thing. It might not be as big. The big news, I think, was this right here, and that was Paul Atkins planning to introduce this thing called the Innovation Exemption. And this is happening by year end, which would allow crypto firms to launch new products here in the U.S. with without these burdensome regulations. That could be a big deal because here are the things that it will affect. I put out a tweet right here. Seamless crypto payments, you're going to see this on retail coming faster. I think you're going to see super apps coming into this, cross-border remittances. That's going to happen, I think, over on XRP and others. And then tokenized loyalty programs. That's probably going to be one of the bigger things that could happen out of this is we see more companies starting to implement across loyalty. All right, guys, that's pretty much it for the day. If you are not part of the Diamond Circle, make sure and get in on that. It is a great place to get additional content from us. I do a special email that is called the Barron Market Edge. I send it out to this Diamond Circle list. The way you can join is clicking the link down below, and it's free. So do that. Follow me on X, @Paul Barron. I'll catch you next time right here on The Paul Barron Show.